It began as a gamble on pixels and became the architecture of intelligence. In the early 1990s, when personal computers were still slow, noisy boxes and graphics meant hobbyist gaming, NVIDIA was born from an act of defiance. Three engineers, Jensen Huang, Chris Malachowski, and Curtis Preem, decided in 1993 that computing itself was broken. The entire industry worshipped serial processing and the method where one CPU core executes one instruction at a time. It was elegant, predictable, and for decades had obeyed Moore's law, doubling performance every 2 years. But these founders saw the limits coming. They believed the future lay in parallelism, thousands of small processors dividing labor like a digital ant colony. And for those watching this through Shorts, you can click the full version link below to hear the complete, uninterrupted story. At that time, such thinking bordered on heresy. GPUs, graphics processing units, were seen as frivolous accessories built only to render images for video games. Hardware engineers optimized for frame rates, not mathematical throughput. The idea of using GPUs for general computation was considered technically messy and commercially unviable. But NVIDIA's founders, operating from a rented office in Santa Clara, treated that orthodoxy as a target. When the company went public in 1999 at $12 a share, it was labeled a volatile gaming stock. Investors saw a hardware cycle play, boom when new consoles shipped, bust when they didn't. Yet even then, NVIDIA's internal documentation hinted at something extraordinary: plans to turn GPUs into general-purpose processors that could solve real scientific problems. Before we dive deeper, note that the full trading strategy reflecting current market conditions is featured later in this video. Stay with us until the end because every technical level matters in a market like this. The turning point came in 2006 with the release of CUDA, the Compute Unified Device Architecture. Under normal circumstances, chip makers keep their low-level software locked behind proprietary barriers. It's a defensive measure to prevent competitors and third-party developers from building on their architecture. NVIDIA did the opposite. It opened CUDA to the public, effectively saying, "Here, make our hardware smarter." That decision violated every norm of the semiconductor industry. The company risked commoditization, letting outsiders manipulate its chips directly. But in doing so, it built the first global community for parallel computing. Researchers in physics, bioinformatics, and eventually machine learning could now program GPUs to process billions of calculations simultaneously. CUDA wasn't just an innovation, it was a strategic realignment that converted a product into a platform. For more than a decade, this move simmered quietly under the surface. During the 2010s, NVIDIA refined its architecture, launching the RTX line in 2018. Real-time ray tracing, simulating how light physically interacts with materials, was a technical marvel, but what mattered more was what it represented: a proof of concept that graphics hardware could perform general, physics-based computation at interactive speeds. Normally, such niche advances peak quickly. Competitors replicate the feature, and margins collapse. But RTX resisted that fate because the same core that rendered light could also accelerate deep learning inference. The commercial value extended far beyond gaming. The GPU had officially escaped its box. By the early 2020s, the world caught up. Artificial intelligence workloads exploded in scale and complexity. Training a modern language model required connecting thousands of GPUs into a single high-speed network, a GPU cluster consuming megawatts of power. Here, NVIDIA's long bet on parallelism suddenly looked prophetic. While rival chip makers were still designing specialized accelerators, NVIDIA already had the hardware, the networking layer, and the software ecosystem. The results were historic. In fiscal year 2025, the company reported roughly $103 billion in revenue, more than double the prior year, with about $36 billion coming from its data center segment in one quarter alone. For perspective, semiconductor companies typically expand at single-digit rates. Doubling annual revenue is nearly unprecedented. The data told the story. The world's AI infrastructure ran on NVIDIA silicon. Investors responded as if watching history turn. The stock surged to around $193 by late 2025. Its price-to-earnings ratio stood near 55 times, an extraordinary premium when most chip makers trade between 15 and 25. Under normal conditions, that signals a bubble. When expectations outrun fundamentals, corrections follow. But NVIDIA's fundamentals were accelerating, not stalling. Margins expanded, cash flow grew, and demand outstripped supply. The typical cause and effect sequence, hype first, results later, was reversed. This anomaly told investors something deeper. The company wasn't being priced as a semiconductor vendor anymore, but as the central utility of the AI economy. Then the narrative encountered resistance. In late 2025, geopolitical currents shifted. The United States tightened export controls on advanced chips, especially those bound for China. Ordinarily, firms navigate such restrictions by lobbying for exemptions or redesigning lower-grade models to preserve sales. NVIDIA made an unconventional choice. It announced that its flagship Blackwell chips would not be supplied to China at all. This decision defied near-term profit logic. China had been a significant end market, but it preserved regulatory credibility. The message to investors was subtle yet profound. NVIDIA could afford to walk away from revenue because global demand elsewhere was that strong. In an industry often accused of short-termism, this long-term stance implied operational discipline and geopolitical awareness that competitors lacked. Meanwhile, technology pressed forward. In March 2025, at the GTC 2025 conference, Jensen Huang unveiled the next-generation roadmap, the Blackwell Ultra platform and its successor, Rubin, planned for rollout from 2026 onward. Typically, such announcements emphasize raw numbers, teraflops, die size, energy efficiency. NVIDIA, however, framed it as a philosophical evolution, the dawn of physical AI. Machines, it claimed, would soon perceive, reason, and act autonomously in the physical world, from industrial robotics to simulation. For analysts, this was more than marketing. It meant the company intended to dominate not only digital intelligence, but the hardware backbone of embodied computation. That declaration expanded NVIDIA's addressable market from servers to entire industries. From a technical standpoint, the chart mirrors this tension between exuberance and discipline. As of November 2025, NVIDIA trades near $193, above its 50-day moving average around 180, and its 200-day average near 150. In market terms, that alignment defines a strong uptrend. The relative strength index hovers around 48, neutral territory. Usually, such readings indicate consolidation before the next impulse move. It suggests that traders are not fleeing, they're waiting. What does this mean going forward? Short term, the $150 to $200 range likely acts as a consolidation band, while valuation digests the previous run-up. Medium term, a breakout above $200, confirmed by volume and supported by data center order growth, could open the path to roughly $230. Long term, if the Rubin platform delivers on performance gains and global AI adoption persists, valuations stretching toward $250 or even $300 are within rational bounds. Yet the significance of NVIDIA's saga transcends price. It redefines how markets value innovation. In the old model, hardware firms were cyclical. Demand rose with product launches and fell with inventory gluts. NVIDIA broke that rhythm by fusing hardware with a software ecosystem that generates recurring revenue. It turned a manufacturing business into a compounding story about indispensability. That shift from cycle to structure is why its valuation behaves less like a chip stock and more like a technology monopoly. For investors, the lesson is clear. Narrative isn't noise, it's a leading indicator. When a company's story and its execution align perfectly, valuation ceases to be speculation. It becomes an expression of consensus reality. NVIDIA has achieved that alignment multiple times. That's why its share price reacts not just to earnings, but to belief, to the collective conviction that this company sits at the center of technological gravity. The next chapters will test that conviction. Competition will intensify, policy friction will persist, and innovation will demand ever larger capital expenditures. But history suggests that NVIDIA's greatest advantage is its willingness to redefine the rules before others realize the rules have changed. For those of you watching, thank you for staying through to this point. And to our dedicated viewers who watch, subscribe, like, comment, and share these episodes across platforms, your support keeps this channel alive. We'll continue to repay that passion with even deeper stories and better content each week. This was value